Good morning from our world headquarters in New York. I'm Manish Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Geopolitical risk rises on multiple fronts for the U.S., with the Pentagon reporting increased attacks on U.S. bases in the Middle East. President Biden appeals to Americans to support the war effort.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
Chair Powell signals a hold for the Fed's next meeting while leaving the door open for future rate hikes, citing the inflation is still too high. And UBS gears up for a fresh round of job cuts at Credit Suisse, targeting around 10% of the support staff. That's according to Financial News. We'll have more on the story through the hour. A very good morning. There's two messages, one for the short end of the curve and one for the long end of the curve. And at the moment, the duration hunters have arrived in the bond market. We're seeing yields drop on the 10-year government bonds. We ramped up by 30 basis points in the space of 5 days. The short end of the curve, 2 years, rolled down. They heard the message, proceed carefully, and persistent changes in FCOM. But the bond market, you've got to ask yourself whether this is a moment of inflection. Lots of people have said it. We will race to 5%. Yesterday, I used the phrase kissing 5%. Well, Morgan Stanley say when treasuries get up there, they are going to be a roaring buy. Now, when it comes to the prism of risk and cross-asset risk, by the way, the biggest steepener, we saw 13 basis points of steepeners go through yesterday. So it really is the long end living in fear. The oil market ramps higher, the second week of advances since this war between Hamas and Israel has erupted. This market has put on 9%. This is the prism of escalation. The U.S. seeks to buy for this special petroleum reserve. What does that do? Allow the Saudis the caveat to release from their unilateral cuts, and gold is actually performing as perhaps a better haven than elsewhere. This is a 13-week high, up 2.4% on the week. Every single day of conflict has given you $13 on the price of gold. Danny, good morning.
Good morning, Manis. And it's probably unsurprising if we're moving into havens, we're buying bonds, we're buying golds, that risk would not be doing well. It was a very choppy session yesterday, and it turned from a choppy one to a terrible one following the comments we heard from Fed Chair Powell, following heightened geopolitical risk. That carries through the future session. S&P down 0.1%. Bank of America, in their flow show, says that sentiment is so bad that it's a contrarian signal to buy, at least for a short-term rally. That bad sentiment carries through to European equities. We're now trading at the lowest since January. Essentially every single sector is down in the European trade today. China also having a tough go of it. The Asia session down 0.6% for the CSI 300. Manis, we've made a round trip. We have now erased all of the gains since we saw last year when China reopened. Morgan Stanley says do not buy the dip. We need to see the economic fundamentals improve first. Now, back to that Powell speech. I want to show our audience, Manis, and for our radio listening audience, what happened to break-evens, because we saw a clear impact from Powell's speech. Break-evens shot up yesterday for the 10-year, about 2.5%. That is the highest level since March, since the banking failures, Manis. It does seem that this market is starting to move away a bit from Powell and re-exerting some skittishness when it comes to long-term inflation.
I think what you've got, Danny, is that the longer end of the curve lives in daily fear and peril of a resurgence of inflation, number one. And two, they do not understand what higher for longer is. There is a lack of definition and a lack of clarity of that. And for as long as you have that, you are going to have this re-steepening of the curve. We can ask our guest, Andy Bremer, in a moment whether this is a steepener exhausted or one which is just about to deliver into positive territory. Let's turn the conversation back to geopolitics, Danny, because it's pervasive in all of our stories. In a rare Oval Office address, the President, Joe Biden, appeals to Americans to support funding for Israel and Ukraine's war efforts.
Tomorrow, I'm going to send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine. It's a smart investment that's going to pay dividends for American security for generations.
Let's get the very latest with Bloomberg's Oliver Crook in Tel Aviv. Oliver, what else did President Biden have to say? What was the core focus of this rare Oval Office address?
That's right, man. As you say, it's a rare Oval Office address. This is really hallowed ground where the president goes to speak directly to the American people, but also on sort of solemn and important occasions. And really what he was trying to do was to liken the terrorism of Hamas, as he would say, and the dictatorship and totalitarianism, he says, of Russia, saying that these two know no limits and they need to pay the price, right? And this he is linking directly to American security, national security needs. And he went straight to the American people to appeal to them. Why is he appealing to them? Because he's going to ask for a lot of money, more than $100 billion, we understand. And we have some reporting on where that money is going to go. We understand $60 billion of it will be for Ukraine, $14 billion for Israeli defense, $10 billion for humanitarian efforts, including Gaza, and some other $20 billion for the southern border, but also for the Indo-Pacific. And really, also in the speech, there was another warning to Israel, again evoking 9/11, saying that Israel needs to act not out of rage. He also mentioned the Palestinians, man, as he said that they did not forfeit the right to peace and to self-determination just because of Hamas's attack. That said, 14 days into this, the aid has still not crossed the border.
And 14 days in, Oliver, and another day where escalation risk is front and center. What is the fear at this moment? What could happen?
Well, Danny, the sort of mood music behind all of this is that Hamas has called for another day of rage today, and one that we saw last week when thousands took to the streets around the Islamic world. And it comes also as Israel continues to strike in Gaza, continues to strike in Lebanon. We understand the Israelis are evacuating more people by the Lebanese border, but we also understand that the U.S. is coming under more fire, the Pentagon says, in its installations in Iraq and Syria. Also, intercepting missiles, they say, coming from Yemen towards Israel. There is the small matter of a huge country of huge importance that sits between Yemen and Israel, and that is Saudi Arabia. So our attention will now turn to a summit in Cairo, a peace summit, we understand. This is completely in flux, but according to people familiar who have knowledge of the organization of the event, it will be attended by the Saudi Crown Prince Mohammed bin Salman, the President of Turkey. There will be members of the EU present, and also the foreign ministers of the UK, Germany, and France. And again, this is going to be number one priority is not escalation.
What's interesting, of course, that you're going to have the UK and France there in the midst of that Arab axis. Those countries have hugely important ties with each of those members. When will Israel move into Gaza? 7 days ago, the three of us were talking about the risk of a ground invasion. The narrative around that type of ground invasion seems to have changed, Oliver, and perhaps that is the nuance that we need to grasp as we go into the weekend.
Completely, Manus. You've hit the nail on the head. What we do know, and again, we're trying to read tea leaves to a certain degree. We heard from the Israeli defense minister. He spoke to troops last night. He said, very soon you will see Gaza from the inside. That is what we've heard. But again, we've heard an evolving story about what this ground offensive could look like. There are a lot of assumptions that this will be a full column that comes in, an occupation, but the Israelis have sort of talked down from this. And what's really interesting, Manus, is to think about what the U.S.'s involvement is in this and giving advice to Israel and cautioning Israel. We've heard a few of the public statements. They've been very couched. But from our reporting out of here in Israel, we understand from Israeli officials that the U.S. is very involved on this on two fronts. One, what form the ground invasion will take to ensure that it minimizes civilian casualties. But then also, Manus, the what comes next. The big question of what happens if Israel is successful in its aims, what will come behind it? The U.S. is certainly involved in those conversations.
Oliver, thank you so much. That is Bloomberg's Oliver Crook in Tel Aviv. All right, let's shift gears now. And Chair Powell hinted that the Fed is inclined to hold interest rates at its November meeting, but left open the possibility of a future hike.
Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy.
Let's bring in now Bloomberg's Jill Desis on this. Jill, we had a Chair Powell here that Stephen Stanley of Santander called willfully dovish. What should we make of this kind of whiplashy Fed speak from Powell?
Yeah, Danny, look, I actually think that at this point, all Powell is saying about the next meeting in November is that this surge in yields has kind of done the Fed's work for them, right? We can just put on a pause there. You don't have to expect that further increase in rates, at least for that November meeting. But I actually found his comments, quite hawkish in the long run, right? I mean, because we're talking about this idea that we've just gone through this historic tightening cycle. We've gone, pause, hike, and yet he's leaving open the door to future rate hikes. I think, Manus, I'm really glad that you brought up earlier this idea of taking the long view and investors really trying to understand what higher for longer actually means in this type of environment, because I think that that's really what this is turning to, this idea of going to 2024, the idea that we could still not just see higher rates, but even potentially, another hike, I think is really, really what we should be paying attention to here.
Well, I think what's even more interesting, when Stephen Major had a coffee with me when he came off surveillance, he said what you've really got to grasp, Manus, is that this world was higher for longer in 2013. That was very, very clear. Here you are, 2023. It's actually higher for shorter, but we haven't really got our heads around that. Look, I mean, to the point, Powell maybe unintentionally gave investors a green light to keep selling bonds.
Yeah, I mean, Manus, look, he did point out that obviously the economy has been incredibly resilient. We have seen a bit of a drop-off, some cooling off in wage growth, certainly. But, I mean, you look at some of those economic indicators, and I think the point here, too, is that, for however many months ago we were talking about the possibility of recession, we're still dealing with an economy where inflation is not coming down, to that 2% target. We're still seeing a lot of those signs there. And, I mean, the fact that he's opening the door to saying, tighter monetary policy could be down the pike, I think that's really what, again, people are paying attention to.
Yeah, Manus and I talked about it at the top of this show. Break-evens 10 years back at their March high. Jill, thank you so much for that wrap-up. Bloomberg's Jill Desis there. All right, now let's get you some other stories that are trending on the terminal this morning. Your top stories. The PBOC handed lenders a record sum of 733 billion yuan in hopes to iron out the swings in rates. The cash injection is the latest effort by China to get its economy back on track with lack of demand and the downturn in the property sector eating into growth. Now, belatedly, a default from distressed Chinese developer Country Garden is all but official. The developer has yet to pay its dollar interest after an extended grace period.
UBS is set to deliver the next wave of job cuts at Credit Suisse, targeting 10% of support staff. This according to reporting from Financial News. The latest downsizing is set to start on November the 6th. This as the company continues to restructure. According to the UBS CEO, Sergio Ermotti, 8,000 Credit Suisse staff have left globally since the beginning of this year. Danny.
And in deal news, Merck has agreed to buy the rights to sell 3 experimental cancer drugs from Japanese drug maker Daiichi Sankyo as much as $22 billion. Daiichi rose as much as 18% on the news. That's its biggest intraday jump since 2005. Merck, for its part, is hoping to bolster its dominance in cancer treatments with one of Daiichi's drugs slated to seek U.S. approval in 2024, Manus.
Well, coming up on the show, we're going to discuss those Fed Chair Powell remarks in a little bit more depth. Andrew Brenner at NatAlliance Securities, known for a comment or two on markets. And we're going to speak to Nadia Martin-Wiggin, Director of Svelvand Capital, on the risks to the oil markets right here on Bloomberg.
You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. It's clearly a tightening in financial conditions. Does it feel like policy is too tight right now? I would have to say no. If a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher. My guess is it'll be somewhere in the middle. The committee is proceeding carefully.
That was Fed Chair Powell speaking at the Economic Club of New York. And Manus, during that talk, we had some pretty significant movement on the curve.
We had. I mean, it was virtual whiplash. But, of course, you and I have run the numbers this morning. We looked at the curve. The short end seemed to cling on to there's going to be a pause in November and didn't really listen to further rate hikes. The long end is living in fear and terror. And I want to show this chart as we go to Andrew Brenner. This is the curve. There was a massive steepening yesterday, 13 basis points, the biggest one day since March, Danny, and we're careering towards zero. So, Andrew Brenner, good morning, head of international fixed income, I should say, at NatAlliance Securities. The short end is hopeful. The long end lives in peril, I would say, of inflation, supply, and deficits. So are we at the start of, again, a much bigger second leg of steepening, of the long end, or are we nearer an exhausted point? Good morning.
Good morning. Appreciate you having me on here today. What I do is I look at what the 2 year's been doing, and I think the 2 years extremely well anchored. Just to point out that on September 20th, the last time the Fed that Powell spoke in the presser, the 2 years were 5.17 and the 10 years were 4.36. Now the 2 years 3 basis points better and the 10 years 60 basis points worse. I think the Fed is done, and I disagree with your previous guest, Jill. I believe the Fed is done. As I look at the December numbers, as I look on WIRP, as I look at the January numbers, I think the Fed is absolutely done, and they're going to let the high real rates that have occurred in the last month do the work for them. So I don't expect the Fed to do anything more. The question is, when do you start buying long rates? And even though 5%, you didn't quite get there on twos and on fives and tens, boy, they sure do look good to me. But I'm not going to be crazy enough with. Go ahead.
Andy, to that point, I mean, there is this risk, if the front end is well anchored, that the long end is unanchored. You look at some of the impact of that. For example, we have a chart, 30-year mortgage rates above 8% for the first time. Does Powell risk here not just letting the long end do the work, but actually losing grip, losing control, and therefore something breaks?
There's no question that breaking is certainly one of the biggest things on our mind. So that's why we continue to put clients in the short end between 1 and 2.5 years. That's where you really should be. But to your point, I look at the banking system, and when I see Bank of America's numbers, where they have $139 billion of losses in their hold-to-maturity portfolio, and I just wonder how many more banks are like that, and at what point will people start to panic about banks again? I mean, that's a large number. And even though Bank of America can handle it, there are many banks out there that can't. So, yes, I believe something will break, which is why I don't think you're going to get significantly higher than 5% on fives and tens. But to the point yesterday, in the middle of Powell's speech, you saw at one point the 30-year go from 4.98 to 5.10 in an instant. So there's very little liquidity out there. This morning, we're seeing better buying coming out of futures. And as you've already gone over the numbers, the Treasury market's, pretty much bull flattening a little bit this morning, but that's pretty much meaningless. Again, the biggest meaning thing is the 2-year anchored. I'm sorry, go ahead.
No. Listen, it plays to what Mohammed Al-Arian said in the FT the other day, which is some of the most, it's one of the most influential markets in the world, the bond market, and some of the anchors that they have, the long-term anchors, the short-term anchors. This is what he said in the FT. The most influential segment of the world's financial markets is losing longer-term strategic anchors and is at risk of its short-term stabilizers ones going as well. If you think about it, that's the Fed prevaricating. They don't know whether they're cutting or, the start of the year, cuts were coming. Now we're higher for longer. Deficits, no sign of a reduction in deficits. And the buyer, the absolute core buyer of bonds is gone. They are in QT. That is the Fed. How destabilized is the bond market?
The bond market, the longer part of the bond market is absolutely in trouble. There's fiscal dysfunction in D.C. I mean, I've never seen it worse. No House Speaker, and people just can't seem to get along. I mean, it's just a matter of time before Moody's takes away the AAA rating of U.S. Treasuries. As far as some of the other things, I'm worried about who is going to be the marginal buyer. The Fed is out, but you know what, man? If you look at the Fed numbers, that when 30 years mature, and old 30 years mature, they might be a week old or whatever. They're buying 30 years again. Same thing with 10 years.
Right.
So the actual duration of the Fed's holding is actually increasing, but that's minor. The biggest problem I have is where the bank's going to be, and can the banks step in and buy treasuries? And I don't think they can.
Okay.
Fair. Manus, one thing I have to say I've learned from this conversation just by looking at Andy is that cash is not trash. It's a fashion statement.
There you go. We got to thank him. You can go back to bed now, Andy, and sort of relax. Danny and I, don't worry about us. We're just here for another 40 minutes driving the bus, changing the gears. But it's good to get you up and get you with us. And the done. There's the headline from Andrew Brenner at NatAlliance Securities. Our guest this morning on the reaction to Chair Powell's speech right here on Bloomberg. Good morning.
Welcome back to Bloomberg Brief. I'm Danny Berger in London with Manus Cranny in New York. Now, Manus, Bloomberg has reported this before, that we know UBS aimed to do a lot of job cuts, 30% with the combined unit. Well, Financial News is reporting early this morning that UBS is going to start that first wave. It's going to be about 10% of staff at Credit Suisse.
And that is probably going to be in those big functional areas of the bank, like compliance and legal. Hey, just some context for you, Danny. You know, the two entities combined is 120,000 people. And the original guidance was a downsizing of around 30%. Or Modi, I think, last said, look, 3,000 jobs will be made redundant over the next couple of years. So it is a huge job to do with a lot of human cost.
Right. It might not be the last time we hear of job cuts to come. Speaking of job cuts, Manus, if you're looking for a new gig, it seems that some CEO roles are opening up. We have this data with exits from CEOs soaring by a record pace.
Yeah, the Great Resignation was supposed to be mere mortals, such as yourself and myself. I am mortal. But, of course, if you look at this report, 350 of them are leaving government and non-profit jobs. That's because their pensions are full. The rest of us have got to slog it out. Hey?
Must
mortals.
Be nice.
Mortals. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Geopolitical risk rises on multiple fronts for the U.S., with the Pentagon reporting increased attacks on U.S. bases in the Middle East. President Biden appeals to Americans to support war efforts. Chair Powell signals a hold for the Fed's next meeting while leaving the door open for future rate hikes, citing that inflation is still too high. And UBS gears up for a fresh round of job cuts at Credit Suisse, targeting about 10% of staff. That's according to Financial News. Well, it was a weird and difficult day for stocks yesterday. A really choppy session to start, ending in pretty strong declines. A terrible day following both geopolitical risks being heightened and Chair Powell's remarks. So you're seeing that carry through the future session, down 0.25%. Bank of America says that positioning is so bad that their contrarian alarms are ringing. Maybe it's time for a short-term rally. European equities, those are also having a terrible day. They are trading at their lowest since January of this year. Basically, every sector is in the red. A lot of strategists questioning whether we'll really get a year-end rally for European equities. And, man, it's just to put a bow on this of what a tough day is. No markets are being spared. Even China, which saw a record cash injection coming from the PBOC. Instead, it's still property stocks worries. Instead, we've seen a round trip. We're now lower from where we were when China first reopened. It's all of those, plus just overall really bad risk sentiment this morning.
Well, that risk is being driven ultimately by geopolitics and the Fed. And if you look at those multi-year highs, we're stepping back from that. Stocks are down, but also yields are down at the same time here behind me on the 10s. We're down ever so slightly, down by 5 basis points just 30 minutes ago. The short end of the curve is listening to the narrative of proceed carefully, but the long end of the curve is trapped. It's really trapped between higher inflation, perhaps a buyer's absence of buyers. We just heard from Andy Brenner there at NAT Alliance going, at around 5%, they are a screaming buy. The Fed is done. By the way, one of the biggest steepeners that we've seen in the market yesterday, the virulence at the longer end of the curve yesterday was really, really pervasive. We shot up by 30 basis points this week on the 10-year. The curve moved by 13 basis points higher. Let's see whether that steepening is done. Oil is up by 9% in the past 10 days. We go higher again this morning. So you've had 2 weeks of volatility and higher levels of oil. Again, this is due to escalation risk across the Middle East, Syria, Yemen, and Iraq. The U.S. at the same time seeks to perhaps fill up the SPR. What does that allow Saudi Arabia to do with their unilateral cuts? Perhaps the more robust hedge is gold, up $13 every day. The value, let's say, of the terror of war is approximately $13 in gold every day since the Hamas-Israel war began. We're up 2.4% on the week, and this is the second week of gains. Danny, good morning.
Good morning, Manus. It really is gold that's been the haven. It's interesting to look. We have bond buying this morning, but in general, TLT, for example, it's lower since Hamas first attacked Israel. It's not acting as that haven. And maybe this gets back to Angie Brenner's point at Not Alliance that sure, 5% looks juicy, but he figures something is going to break. Do you really want to buy if that's the case?
But that's the second guest this week that has come on the show and said something will break and that will be the alpha for the bond yield to drop further. The question that goes through my mind is a roll down in yields of 5 basis points on 10-year paper. Is that duration hunters arriving, or is that really people who want to load up on bonds as a defence, even though the argument is the other kind of assets are perhaps a little bit better for you to consider, whether you want to have a flank and perhaps a hedge against escalation risk. Danny.
Well, oil is certainly doing that for you. And it's set for an additional boost, Manis. The U.S. is aiming to buy millions of barrels of crude for delivery, just as prices, as we've been talking about, have been lifted by the crisis in the Middle East. Joining us now to talk about this and all things oil and energy, it's Nadia Martin-Wiggin, director at Svelland Capital. Nadia, what do you make of the timing of this? The U.S. wants to buy in December or January. What does this do for an already tight and already fearful oil market?
I think the main point of that announcement is to tell Saudi Arabia that they're back in the market. This is the original price floor that Saudi Arabia and OPEC Plus have been trying to protect, is around $80. And the U.S. is finally saying, OK, at $79 a barrel, we're buying. So 2 weeks ago, before this war broke out in the Gaza Strip, we had the U.S., Israel, and Saudi Arabia talking about a deal, right? And as a part of that deal, Saudi Arabia would bring back more oil in January. So I think this announcement is about pushing Saudi Arabia to be open to do that for the U.S.
It'll be interesting then when we go to OPEC in just over a month's time, Nadia, to see whether Russia and Saudi Arabia do travel that road that you suggest. I think the last thing they want to do is let the taps open and undo some of their work. But that's the other side of the trade. You say, and we quote, that's why we asked you what you think. Ultimately, the oil market will adapt to the realities. If necessary, trade flows can be altered. SPR inventories can be tapped. And production in some countries can be raised. And some demand may be destroyed. Where is demand destruction? I mean, we haven't touched on that for a while, have we? We've talked a lot about $100 coming along, but I haven't heard anybody talk to me recently about demand destruction.
Yeah, and this is when we put it in that macroeconomic environment. The demand destruction argument has been coming since interest rates started, right? And that's where we've had this skew in the oil market to the downside. Now we're finally in the situation where the bad news is out on the demand side, and now we're really looking at the supply side shocks, which is creating this positive skew of things. I think where the demand destruction really happens is probably at around 110, 120, maybe even higher. And the key point is whether it's lasting, because what we saw with Russia's initial invasion of Ukraine in this war is things popped higher, but they didn't stay there, right? Because we reshuffled things. The difference is in natural gas, that is where we had the prices have to stay at such a high level to really destroy demand.
In some of the other reshuffling, Nadia, what will be the impact of more Venezuelan crude coming onto the market? Is this just, as some people have labeled it, a Band-Aid, or can it really do something to smooth out some of the volatility?
In our view, it's too little, too late. Really, the Biden administration needed to be working on this for the last year, because when the initial opening happened, since then, we've had 150,000 barrels per day of additional crude come out of Venezuela. But now there are infrastructure delays, and that means investments by oil companies to bring out more production. Within 6 to 12 months, we can absolutely get an additional 500,000 barrels per day. But who is going to trust the Biden administration when we have a U.S. election coming in November, when Biden might not be in charge anymore? And his track record hasn't been fantastic in terms of following through on what he says with oil producers, as we've seen in the shale patch.
What is bigger and more paramount in your mind? We started the show at 5:30. We talked about a 9% rally in the price of oil in the past 2 weeks. Are you looking at the geopolitics as a serious alpha for this market? Bloomberg has run the numbers. On a real escalation, they see $150. How do you think this market is positioned? Because the hedgies had slashed their positions going into this war. So what is the risk of $150 on real escalation? You're in the market. You tell the economics team what you think.
Yeah, I mean, it's very hard to be short this market now, right? So increasingly, I think there are more and more positions going to the upside, and that is what we absolutely saw last Friday. But are people all in? No, because right now we haven't lost a single barrel of oil yet, right? We haven't even lost any natural gas. So I think there is absolutely more positioning that can come. And this is where, where we see that temporary shock, it will be a very high price. But where we see that lasting, it might be $110 a barrel. It might be $120, $125 a barrel. It really depends on the macroeconomics. And this is where our view is that we're really in soft landing territory in the US. So the demand is slowly going to pick up and do okay. And we see record imports of oil in China. So China is doing super well in terms of oil. The only part that is lagging is on gasoline. That's where we see that travel is not that high, and that's in the US. And that's, of course, the first headline that everyone has been focusing on to put a bit of their shorts on. But this is where I think if things were to calm down now in the Middle East, we get a stalemate more like we saw with Russia and Ukraine, then the oil price will actually come down first. So
Nadia, then just to put a finer point on this, we only have less than a minute here, but what trade in this energy patch do you have conviction around that you're happy and confident to put on now, given a lot of cross currents we just walked through?
Well, it is definitely much better to be towards the upside, right? Call options, that sort of thing is the stronger element, because going into these weekends, things could really jump off right now. And then I think when we look on the general macro commodity space, being long other commodities like iron ore and things like that are also continuing to have a recovery, that is another good spot to put one's money.
Okay, Nadia, afraid we're going to have to leave it there. Thanks so much for joining us this morning. That is Nadia Martin-Wigan of Svelland Capital. Now, to that point, a quick check on these markets. You are looking at both Brent and WTI charging higher by 1%. $90 a barrel on WTI, 93 when it comes to Brent. Gold also moving on this too, trading at the highest since May as nat gas comes in. This is Bloomberg.
I'm still running for Speaker, and I plan to go to the floor and get the votes and win this race.
That was Congressman Jim Jordan after emerging from a 4-hour meeting with Republicans. Kate Ackley is with Bloomberg Government. I mean, the latest. I mean, it makes British politics look positively calm, doesn't it? I mean, where are we with this, with Jordan? Another vote today?
Right. Jordan is going to have a press conference at 8 o'clock this morning. And then the plan is for a vote at 10 o'clock on his, bid to be speaker. It'd be the third vote. We don't see a lot of change in terms of, is he going to get, more support, less support? Probably it's going to be about the same. He had about 20 Republicans voted against him the last couple of rounds, more or less. We don't see that changing a lot. We're not seeing that, something is dramatically different. And basically, this has just paralyzed the U.S. House of Representatives. It's not, House Republicans do not have a governable majority.
And without that majority, without that functioning of government, Kate, what does it mean for sending money to Israel, to Ukraine, to help them fund what's happening there?
Yeah, that's a really good question. It can't happen without, an empowered Speaker of the House. And so the last 2.5 weeks that we've been in this kind of speaker crisis, if you will, one of those weeks was going to be a recess week. Congress wasn't going to be in town anyway. So now, though, with the president planning to send this budget request, we're talking about tens of billions of dollars, maybe $100 billion for funding for Ukraine, funding for Israel. if the House can't move, people are going to start to take notice. And this is going to be, a problem for House Republicans and a problem for the U.S. government overall. And I think, we also have noted repeatedly that in mid-November, U.S. government funding, will run out. That continuing resolution, that stopgap will run out. So that's when the U.S. government could have a shutdown.
So there's multiple crises coming down the pike, so to speak. What is the risk that Patrick McHenry, and this was one of the suggestions yesterday, that Jordan step back and they let McHenry step in until the start of the year to give him more time to get his ducks in a row. Is there a coalescing around McHenry? Is that a real possibility?
It looked like it yesterday. This is where yesterday was a kind of a whiplash. Patrick McHenry is going to be a temporary speaker with real authority. And even Jordan was said to have backed that. But then other people in House Republican leadership said, no. And there was sort of an outcry. No, we're not going to do that. So, that's off the table for now. But who knows? Again, you feel this whiplash of different ideas coming and going as they try to work through this.
Kate, thank you very much, as always, for getting up early for us this week. Kate Ackley of Bloomberg Government. Now, shifting over to China, the PBOC kept its 1-year and 5-year loan prime rates unchanged, but had a record cash injection in one of its shorter-term liquidity tools. Joining us now to discuss is Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins in Hong Kong. Rebecca, what kind of signal was the PBOC sending from this?
Yeah, as you say, LPR rates unchanged as expected. But what wasn't expected was that record amount of liquidity injected via that short-term monetary tool, and really sort of emphasizing its commitment to try and ensuring that there is enough cash and the costs remain low enough in financial markets to allow some of those tentative signs of growth that we've seen to really take hold. And it's also sort of anticipating this demand for cash as we head into tax season for China, which will be a sort of another strain for some. We've already seen China cut benchmark rates and the reserve requirements for banks twice this year, and that has had some effect when we look at, for example, that third quarter GDP up 4.9%, slightly higher than economists had expected. But the prevailing concern, of course, is still property, and that is really sort of the big unknown.
Well, it's certainly one of the biggest unknowns, and it's what the government are battling against, isn't it, with all of the incremental policies. How much of a problem does the real estate crisis really pose, Rebecca?
Yeah, I think that's the critical question. I mean, Beijing hopes that we're now coming to the end of the crisis, but the reality is that we have Country Garden, once China's largest developer, on the verge of an official default. We have sort of investors planning for some kind of restructuring scenario already, and it is a huge firm in China, and it is significant symbolically too that we would see a firm of this sort of scale, and a firm that has actually, by comparison to, say, Evergrande, borrowed quite responsibly over the years. It didn't expand into sort of huge conglomerate, for example. And the scale is important. We see a lot of the projects in third and fourth tier cities, smaller cities in China, where consumer consumption is a bit slower to bounce back.
Well, if we're talking Evergrande, we got to talk about Country Garden, too, because another day of, well, did they default? Did they default? But we just can't call it that. Where do we actually stand on Country Garden and potential restructuring to come? And quickly here, Rebecca.
Yeah, I think we are in a default, but all but name. I mean, I think in terms of investors' perspective here, we already had a statement from a company saying they don't expect to make all their offshore payments, and we're just waiting for that sort of final official tag. Investors at Country Garden already starting to prepare for a restructuring. And in fact, that is reflected in the bond price. We didn't have much of a movement, even as we came through the end of the grace period on the 17th, 18th October this week. So expectations is that we are going to see some kind of restructuring scenario. It's bad news for China. Another huge, complex restructuring on the horizon, just as Evergrande today, for example, has said it needs more time to reassess its own restructuring.
Okay, I look forward to the things that we missed. You got to go on Twitter and get Rebecca. It is literally, it is the upsum of the week. I have envy I have Twitter envy, not Twitter envy, X envy. Rebecca, thank you very much. Rebecca Chung-Wilkins, I just destroyed a couple of $1 million worth of rebranding there. Let's talk about the shekel, because we have seen, again, some pretty tough moves, Danny. This is the dollar rising, the shekel falling. This is now the weakest since 2011, and the options markets show that they're getting even more bearish. We're going into the weekend where the risks are rising on multiple fronts of ground invasion, as well as the risks in Syria, Iraq, and of course those missiles that were down that came in over the past 24 hours by the US side.
Yeah, and man, as a quick look at your other currencies this morning, you do see some dollar strength coming through. Notable currencies, sterling having a tough go at it. Some UK retail sales data we had today slid, not great. And yen made another go at 150, but there's that huge options wall there that keeps beating it down. For now, we're at 149.93. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day with a look at what's ahead. We have a lot of earnings. We're going to get Schlumberger, Amex, regional financials, and Huntington. Those will all hit before the opening bell. Then President Biden will be hosting European Commission President Ursula von der Leyen and European Council President Charles Michel in Washington. And then it's been a really big week of Fed speak, and that's going to be wrapped up with Presidents Harker and Mester at 9 a.m. and 12:30 p.m. Eastern, respectively. And Manus, the voice from Powell has been the same as we've heard from others. I'm sure we'll hear from Harker, who tends to be dovish, is this proceed carefully narrative. Yeah, I mean, the short end, what we are seeing is yields overall coming lower this morning, 10 years coming back from that near 5% level. The question you need to ask yourself as you go into the weekend is whether that drop in yield, Danny, is as a result of duration, brave duration heroes arriving, I don't know, or is it some form of hedge? There's a couple of micro movers we got to keep an eye on as well. I call them micro. I hardly call American Express micro. But they're going to give us their earnings before the bell. And then you've got UAW and GM. They're inching towards a tentative deal. I mean, we've seen this before, the union negotiator says. But, I mean, that's going to be high on the agenda if there's breaking news over the weekend for GM. Danny. Yeah, and Manus, to that point, I mean, it's one of these many shocks. We talk about a potential wage shock from some of the strike negotiations, supply shock, all those kinds of things had been pushing yields higher. But what we are seeing today across bonds is they are getting that bid. As you say, is it finally those brave enough to buy duration, at least for the U.S., or is it haven bids or something else? Well, one thing for sure is you saw one of the biggest curve steepeners go through since March. This is what you and I looked at 3 a.m. this morning. 13 basis points, curve steepening. We're almost back at that zero. Does that continue? Because I would say the long end lives in peril and fear of a lack of a surety from the Fed on what they're going to do. It lives in fear of inflation. It lives in fear of supply. It lives in fear of deficits. I think there's a heck of a lot of fear that's driving the long end of the curve. But, of course, we had Nat Alliance with us this morning. And Jim has a very different view. He's gone back to bed now, apparently. Yeah. Andy Brenner, look, can't blame him. Gone back to bed. After saying something will break, he just turns off the TV, turns off the camera, and goes to bed. I wish I could live with that kind of thing and not let it keep me up at night, Manus. Living the dream, living the dream. The Fed's done. From New York. Good morning.